The Middle East and the jobs report really ran the show this week. Neither went in the direction we needed. Oil prices kind of bounced between $90 and $95 all week as the Iran situation kept flipping. Last Thursday, we got reports of a deal to reopen the Strait of Hormuz, and that sent prices lower. By Monday, Iran pulled out of negotiations over Israel's ground assault on Lebanon and then threatened to block the strait again. On Tuesday, talks resumed. Wednesday, Hezbollah rejected a ceasefire and new tariffs were proposed on up to 60 countries, and that adds to inflation fears. On Thursday, we got a Lebanon ceasefire, but attacks continued after it was announced. And we keep hearing the deal's close, but it just never seems to come together. So until that changes, oil prices are going to keep pushing inflation higher, and mortgage bonds are going to, get hurt by that. But it'll be interesting to see what the Fed does. Before I was born, during the last oil-driven recession, that was in 1974, the Fed actually cut rates while inflation was running hot, which is happening now, and mortgage rates came down over a full percent. And separately on jobs this week, it was a full jobs week, and the numbers came in stronger than expected. ADP showed 122,000, Revelio showed 124,000, and today we got the BLS report, which blew past estimates. There was 172,000 jobs added, which was double what we expected, or at least kind of was expected by the market. And with prior months, those got revised up by 93,000 too. So the 3-month average is now at 188,000, and this just shows some strength returning to the job market. But the quality of those jobs does matter. Most of them came from government and healthcare, which have nothing to do with the economy. Plus, we saw full-time positions actually lose 79,000 jobs, and part-time jobs were the ones that surged. We saw 266,000 created. Long-term unemployment hit its highest level since 2021, and small business hiring plans are at their lowest since May 2020. So while the headline number does look strong, the picture is really more mixed than that. Consumers are showing real stress. Credit card delinquencies hit the highest we've seen since 2011. Car loan delinquencies are at their highest on record too. And that kind of pressure kind of leads to less spending, and then in turn there's weaker economic growth over time. Good news is that recession fears can actually bring mortgage rates down. And one product update worth knowing is those VantageScore 4.0 acceptance has now been adopted by all 30 of the largest mortgage lenders in the country, and it can score about 33 million more consumers than traditional methods. And that's just kind of by incorporating rent and utility payments. But for buyers who were borderline before, this could open doors, and it's just another reason to reach out. Next week, we're going to get CPI, PPI inflation reports, as well as jobless claims. If inflation does come in cooler, we could see some relief, but if not, rates are likely going to stay where they are unless, news out of Iran, because that's way more important and could change everything. But I'll see you next Friday to let you know how things shake out and what actually happens.